Welcome to RenMac Off Script, where we discuss markets, economics, policy, history, life, and the Rangers. It is the 17th of May, 2024. I'm Jeff DeGraff.
I'm Neil Detta.
I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account at RenMac LLC and our LinkedIn page. And if you are not an institutional investor, but you want to get more of our work, join us at RenMac Access. That's renmacaccess.com. Big news this last week was, I believe, Steve Pavlik, certainly inflation. We're going to hit on that. But we were given the news that we are going to have a debate, right? And we're talking about dates and like the whole thing's kind of coming together. Skewed in any way? I mean, whose advantage is this working toward, and why?
Well, we did get news that we're going to have two debates. They're not going to be done by the Commission on Presidential Debates. They're going to be negotiated by the two campaigns. And I don't know how much, candidly, of a negotiation there was. You've had Trump taunting Biden for weeks, anytime, any place. But that made it very difficult for Trump to dictate any terms, which is why they're all going to be favorable, in my opinion, to Biden. You're having him on two of the least Trump-friendly networks, although you could probably argue that aside from Fox News, most networks are sort of not friendly to Trump. But you're going to have the first one, I believe, June 27th on CNN with moderators Jake Tapper and Dana Bash, two very outspoken critics of Trump. And then you're going to have the second one scheduled for September 10th on ABC. It's going to be interesting to see who the moderators are, because Trump is suing ABC News and George Stephanopoulos over an interview that Stephanopoulos did with Representative Nancy Mace.
That guy, by the way, I mean, he sues people like I chew gum. Like, it's just, he's just like, sue you.
He does, but my guess is if Trump, the issue at the time was Stephanopoulos' sort of claims regarding sexual abuse allegations against Trump. And my guess is if Stephanopoulos is the moderator there, he'll be quick to point out that Stephanopoulos defended Bill Clinton, and he'll probably make a few references to Jeffrey Epstein. So tune in to see if that is the case. But again, the terms are, in my opinion, very favorable to Biden. The fact that there are two, I think,
was
is
Rachel
also,
Maddow not available for the?
I believe she's on NBC, and Biden right now will not commit to doing any more debates. But I think the timing's interesting. The fact that the first one's going to be in June 27th, and some have suggested that Biden's team may have felt, again, compelled less by Trump's taunts and more of a desire to change the trajectory of the race, because we've had battleground polls sort of consistent going back to last fall that showed, despite spending tens of millions of dollars in those states, Biden's not making any headway. In addition, the legal cases that some Democrats were relying on to sort of take Trump out of the picture, most of the serious ones aren't going to materialize now before the election day. You're just looking at this hush money case, which most people consider to be the relative weakest in terms of both the political impact as well as the legal standing. So I think, it's probably motivated more by a desire to change the trajectory. That can work one of two ways. Biden could go out there, and Trump has done a really good job for the Biden campaign in terms of lowering expectations. The key to happiness is low expectations. Nobody should be happier than the Biden campaign, because if he simply shows up and doesn't do a horrible job, he'll likely hit those. This will be an unscripted moment. So, whether Biden goes out there and sort of, again, clears that bar, or if he reaffirms people's biggest concern. I think it shouldn't be pointed out that Democratic convention's in August. And if he does sort of reaffirm his biggest political vulnerability, his age and cognitive condition, that would give Democrats time to move on and potentially dump him at the convention. So I think that's sort of the thing to watch there. For Trump, he's been calling this for a while. I think he's looking for an opportunity for to demonstrate strength. I think he's not going to take or receive advice from Chris Christie like 2020, where Christie suggested that he continually interrupt Biden to trigger the stutter. That didn't go well. I think I'd be surprised moving forward if he doesn't try to give Biden enough political rope to hang himself, let him talk, and try to hope one of these gaffes or senior moments sort of rises to the surface.
Yeah, I mean, look, I think it's evident that the kind of wishful thinking of he's going to have this big terrible moment just hasn't materialized, right? Didn't do it at the State of the Union. I mean, he has these one-offs, but you kind of wonder if that's just part of the selective, the selective part of journalism.
You would think that Trump would know this too, because
Yeah.
Hillary Clinton did it a lot to Trump in 2016, and when he just sort of walked across and appeared relatively controversial or presidential and didn't commit all these chaotic things that she was predicting, again, you would think that having benefited from it before, he would appreciate that, but
Yeah.
so far that's
You,
not the case.
you had a great stat earlier in the week, and I want to get back to it about the $1.1 trillion of the of the well-named Inflation Reduction Act. Here's $1.1 trillion. We're going to call it inflation reduction, which is fantastic. Neil, let's get your take though. Inflation this last week came in kind of on the screws, right? I mean, it was at expectations, and the market loved it. So talk to us a little bit about inflation, what the data told us, the trajectory of that inflation. Then I've got a couple follow-up questions on, how you're thinking about the world, but go.
Well, go Knicks. You mentioned the Rangers. Feels like we're back in 1994, right? I mean, with the
Right.
Knicks.
Soft landing, the whole thing.
Yeah, it feels pretty good. But yeah, I mean, inflation, you're right. I mean, headline inflation came in a touch weaker than expected. Core inflation came in right on the nose. I think it was right for the markets to get excited. I don't think it's right to get too excited, if that makes sense, because I don't think this is really enough to change the Fed's calculus. We need to put together a string of better inflation numbers, and we're not there yet. So, I would kind of keep, if I was the Fed, I would kind of keep the markets on a short leash, not try to get too carried away here. But I do think it's important to kind of think about the outlook. And, a few things stand out to me. I mean, we did see a moderation in both primary rents and owner's equivalent rents. And I think that probably continues over the summer. So there's been a lot of discussion about how rental inflation has been stubborn and sticky, and why isn't the slowing in new tenant rents showing up in CPI rents? And that looks to be happening now. I mean, there's still a pipeline of rental disinflation in front of us. We really haven't seen a boom in home prices, so it's not like the underlying value of the asset itself has been rising. I mean, if you look at home prices over the last 24 months, I mean, it's not rising very rapidly. We're past a lot of the initial run up in home prices at this point. Looking ahead, I think the slowing in the equity markets in April will probably matter for core PCE inflation in the months ahead, because that bleeds in mechanically into portfolio management, which is something that matters for core services ex housing. Medical care is another one. Medical care was very strong in the first quarter, and it's not likely to be as strong in the second quarter. And then looking at the good side of things, supply chain pressures continue to ease. We did see a drop in used car prices last month. There's probably a little bit more of that to go. But we also saw a huge increase in apparel. So, I thought what was interesting is that, inflation was what it was, despite a pretty significant increase in apparel, and that probably will not last. I mean, if you look globally, clothing prices have generally been declining everywhere, Canada, UK, Euro area. So it's really difficult to see why it's rising so rapidly in the US. That can unwind pretty quickly, and that would again introduce additional downside pressure to core goods inflation. So
How big of a component is that from is it significant?
it's about 12 to 14% of core goods CPI, I think, around there. So, it's not insignificant.
It'll matter.
So I think, these are sort of the things that we're keeping an eye on. But, again, more broadly, labor markets have cooled, and there's really not much evidence that labor markets are reheating. So you have to wonder a little bit about where the inflation's coming from. So I feel pretty good about where inflation's going. I think that should continue to kind of push the markets in this direction of kind of soft landing enthusiasm. And I think for the Fed, it's important to just rhetorically not get too carried away. It's 1 month. we're not close to cutting yet. You know, you have to kind of say those things because you want to kind of keep markets in check.
Well, and in fairness, the markets have a relatively short memory, right? They don't really hold the Fed to that. I mean, remember in 2018, how they were talking, and most recently they can change their mind pretty quickly. I know they don't want to do that, but it's not like it hurts their long-term
I
credibility
mean, I
as
think
long
for
as
the Fed, right, you don't want to get into a situation where inflation is slowing and then very quickly the market starts pricing in like 6 cuts again.
right.
Right? I mean, that's kind of I mean, look, the market should be pricing in cuts. That to me makes sense, but there's also a very mechanical impact between equity prices and certain areas of PCE inflation that the Fed is laser focused on. And, one way to kind of avoid that is just to make sure, rhetorically, to the extent that's possible. I mean, obviously the Fed can't control asset prices, but they can lean against it from time to time. That's something to keep in mind because, equities do matter for certain areas of core services like housing.
Right, for sure. So let's bring this together and talk a little bit about Steve had an interesting piece early this week, and I know it was from data from Politico, but it was I think caught a lot of people by surprise, myself included, which is of the 1.1 Inflation Reduction Act. Again, snicker. What percentage of that has been spent, and what's earmarked for kind of immediate spending, and when does that go into the economy, and what does that do to Neil's inflation numbers as we think about it?
Well, sure, the bulk of it was from the Inflation Reduction Act, but I believe the total for all sort of 4 bills
Right.
in Biden's
Which
presidency
is
was
the
about one.
infrastructure and all those things, right? Yeah.
Correct. And the CHIPS Act was 1.6 of that total. About half a trillion is in tax credits. So you sort of look at that remaining 1.1 or so. Politico found that as of April, only about 17% had been on contract. Now, we've seen a lot of the announcements recently, particularly on the CHIPS Act side, but because of the process to go through actually getting that money on contract and to those chip makers, it's probably going to take at least a year. So that's sort of where some of the disparity might lie in terms of what people are seeing versus the Politico total there. And I believe with their analysis, they found that a little over 300 billion is actually for future spending in future years. But still, that's a significant chunk. My math's about
So
800
yeah,
billion or
so let's
so.
break that down, right? So 1.1 minus 300 is 800,
Yeah.
of which 200 has been, or 180-ish has been spent, probably, right?
Yeah, no, I mean, there's a lot of money still in the pipeline,
Yeah,
and
$600 billion. And what's the time frame of that?
well, I think that sort of gets into some of the challenges. I know on the energy side, there's been a lot of concerns with the permitting, and it's harder to put the money on contracts. This goes back to the Obama administration with just the shovel-ready jobs, and just the rigmarole of having to distribute the funds. I think
You know who's
so.
ready? RenMac. RenMac's ready. We can take that. We can take the funds. We're happy to help. Whatever we need to do. We're happy.
Here's a question. If Trump gets reelected and you have a unified Republican government coming out of the fall elections, are they canceling that spending?
It's a good question, one that a lot of clients have been asking. My guess is it's possible. I don't know that it's probable. So yes, if Republican
Yeah,
Congress
why
with
would they
Trump.
cancel it? They'd probably try to get the money out faster and take credit for it.
Totally, right? You're right. Somebody else done it. We'll spend it, and then we'll blame them for it. Absolutely. Come
A
on.
lot of money has been allocated to Republican states, particularly in the South, with a lot of the Inflation Reduction Act and the green energy subsidies, presumably because it's an easier environment. The regulations are fewer, which means the money can get on contract sooner. You also typically have right to work states, which means the dollars can go a little further towards these EV goals, particularly on the battery production side. Uh, you know, I'm skeptical that they're going to be able to do this. Recall that when Trump came in with the Republican Congress, it was about repeal and replace Obamacare. They weren't able to do that. I think in terms of how many times you can use reconciliation, that's also a concern because regardless of the power structure next year, there's going to be a lot of debate on this tax package because the individual portions of the Trump tax cuts are expiring. So again, I'm skeptical that there's going to be much momentum and effort to try to necessarily reclaim a lot of these funds. At this point, and even though that a lot of money hasn't been spent, it's not necessarily sitting in the coffers at the Treasury either. So just, that question of how much could you actually recoup remains out there. Where I do think Trump could have a bigger impact here is directing the Energy Department and the Treasury Department more directly in terms of the eligibility for those requirements. I think that's where you can limit it to, try to keep some of those funds from necessarily going out the door, even though he's contractually, or I believe legally obligated if you're working under the existing law. And then in terms of, who's going to be the recipient of those funds, maybe Trump starts to make fossil fuel firms eligible for some of the
Right,
energy
exactly.
funds there. So it wouldn't surprise me if that's not more the direction of where things end up.
I mean, that could easily just work totally, and he's very good at this, right? Like using I mean, I always liken Trump to third and long, and everybody comes at him in blitzes, and he just dumps a little, screen pass over the top and first down, 20 yards, right? And like he's very good at baiting people and then just absolutely destroying them at the same time. So he collects all this money or has the ability to, start allocating these resources in his favor, the Republicans' favor, in whatever that might be, whether it's fossil fuels or putting up Confederate soldier statues again, whatever it might be. I mean, unbelievable.
I'm with you. I don't think he's going to be as quickly to turn it over as some of the
Yeah,
Republican lawmakers. But what I do think
he
should
loves to spend money. I mean, that's pretty clear, right?
well,
So
that's his background as a real estate developer.
right,
He's the king
right.
of debt. I mean, he doesn't have an aversion to this. But I guess where I sort of think about getting into a little more of Neil's world is, there is a lot of money here. Okay. Is that going to complicate something the Fed needs to think about is when that
Right.
might be distributed? You're also going to start next year with the debt limit trigger, although I don't think we're actually going to come up against that deadline probably till the summer, given the most recent standoff. And then we're talking about tariffs. You have Biden raising tariffs. I think those were more symbolic just because at this point, a lot of the decoupling's already occurred more about the 25%. So if you're not doing trade at 25%, raising it to 100% really doesn't do anything for you.
Right.
It's just good politics. And
Yeah,
Trump sort of
symbolic.
forced him in there by saying he was going to do that. But if Trump comes in, he's talking about additional tariffs. And, usually those are considered inflationary too. So, I'm not sure where the Fed is on their thinking about all these things. They're probably, maybe they'll fight that battle next year when they get to next year. But it's just something to see how they all sort of come together here.
Yeah, I guess that is the question, Neil, is does this fiscal stimulus and the money that is, likely to be, or at least try to be allocated over the next 6 to 12 months play into the Fed's calculus, or are they just purely reactionary, right? I mean, are they looking forward and saying, hey, this money's going to get out there, therefore, instead of maybe the trajectory would be 3 cuts, we don't need to do that. It's just 1 cut. How do they think about that?
No, I don't think they're thinking about that right now. I think what they're
Yeah.
thinking about is the data that's coming out in front of
Right.
them. Right? I mean, they've been very clear about that. It's the sort of near-term data flow that's going to determine the near-term path of interest rates. They're not thinking about things like monetary offset of fiscal policy and what if they come in and they spend a bunch of money or layer on more fiscal stimulus on top of whatever is going to be spent. I mean, that's not really the calculus right now.
That sounds like a good white paper, though, doesn't it?
I mean, they did a little bit of that I mean, arguably, I mean, I think in 2017, but I mean, in the broad scheme of things, I think the Fed is largely just taking the world as it is, and that's what you should do because you don't want to respond to something until you have the details, particularly when it comes to fiscal policy. So I think, is whatever happens in DC, is that going to be enough to offset the continued disinflation in rents or moderation in the labor markets? I'm skeptical of that. So I think the Fed will probably just look at the data as it's coming to them and respond in kind.
Yeah. Well, the markets certainly have appreciated not only your inflation numbers, but kind of what's happening. We've got obviously a new high in the S&P, and I think importantly and under-recognized is that NYSE breadth also confirmed that new high. So that confirms the uptrend. This is This is a mid-stage bull market, not a late-stage bull market. That's where you get those divergences. 20-day highs did advance. They did not eclipse. They will not eclipse, by the way, the December high, which was about 71%. That was a very unique number. But certainly, as we've gone on to make this this latest high, 20-day highs matching where we were back a couple months ago at those highs. Beta starting to improve. Momentum, the momentum trade, which we called back in late February as a peak, I think has played most of itself out. That's not to say that we're going back to momentum, because we don't think that that's going to be an important factor. I think it will be just kind of average. So just skew yourself more towards beta than momentum. But I do think short rates have peaked. I mean, to me, the chart of the 2-year yield looks like a top. That implies at a minimum something about 4.25% on the 2-year yield. We break that and we break the neckline, and then it's lower. How do you feel about that, Neil? Are you in the camp that bond yields are peaking? You think they're stable? Where do you come down from your ivory tower economic view?
Thanks for that. I put it to you this way. I think think about what the outlook is for the fixed income markets based on the Fed, right? So number one, growth could be steady and inflation will be slowing and the Fed cuts. Growth could be slowing and inflation could be slowing and the Fed cuts a lot. So to me, there's just more momentum behind lower interest rates. It's either do they cut a little or a lot.
Right.
So if it's me, I mean, it's not an environment where stocks can't work, but I would probably pick, if I had to pick one over the other, I'd probably pick bonds over equities over the next few months or quarters. So that's sort of how I'm thinking about it. But I think that there's a distribution of risks or outcomes that skew towards lower yields at this point.
Yeah. Well, if that's the case, I think that's rocket fuel for equities. We had the 20-day highs, right? And so the good news, home builders obviously responded really, really well. They are late cycle in our SERM model, but man, there's nothing wrong with those charts. So we'll stay with them, though. That's kind of a nervous call. Banks are acting great. So again, another sign that this decline that we're seeing in rates is not about the Fed pushing us into recession. Double B versus triple B spreads making new cycle lows. And then I think one thing that catches people off guard is that we've got a very strong seasonal tendency, particularly in an election year, over the next 2 months. And I think this is this combination of lower rates, the breakout, better inflation data, seasonality, credit, all these things coming together really aligns us pretty well for the summer months. And then I would just sprinkle on top of that, China continues to act well. We've called a bottom there, continue to believe that that's a big turn. I had a conversation with a friend of mine just yesterday, and he kind of asked where I was on that in terms of the impact of that call. Is it a big call? Is it kind of a more of a tactical call? And I said, I think, and this is a true statement, I said, I think that the turn in China is similar to the U.S. turn in 2009. I mean, I think it's that kind of call, right? Where it is going to be a multi-quarter call. Things are going to play themselves out, and you're going to look back in 2 years and go, it was so obvious I should have been a buyer, even though the narrative might not have been fully aligned there. What's on store next week, Neil? What do you have?
It's going to be another sort of relatively quiet week. We'll have some data on new home sales. I think given the backup in rates that we saw leading into that month, we probably see some slowing in new home sales. I mean, the residential investment areas have not been particularly good to kick off the second quarter, whether that's construction activity and sales. So I think sales will be somewhat more sluggish. Builder sentiment has been weakening, generally speaking, so I think there's some downside there. We'll also get data on durable goods, and the news there. I mean, core durables should be somewhat better. I mean, CapEx probably is more of a bright spot going forward. Companies feel a little bit better about the world. corporate confidence is better. So, you probably see some of that bleed into, non-defense capital goods orders.
Steve, what's happening in DC next week?
Well, I think at this point, the legislative window has essentially closed. You're going to see a pivot by both sides to a lot of political messaging bills that aren't really intended to go anywhere, just try to score points heading into the election. So in the Democrat-controlled Senate, you're going to see a resurrection of the bipartisan immigration bill, try to benefit Biden, put Republicans on the defensive on that issue, which tends to be rising in terms of importance in several of the battleground state polls. So that's what's going on the Democrat side. On the Republican side, and Republican-controlled House, you are going to see more pressure on holding Attorney General Merrick Garland in contempt for not providing the audio tapes of Biden's interview with Special Counsel Robert Hur. You recall that Democrats took issue with Hur's characterization of Biden as an elderly man with a poor memory. Republicans are saying, well, if that's the case, then show us the tapes and you can prove it. So draw your own conclusions depending on your political point of view. But again, from an investor standpoint, I think the big thing is that you're not going to see major legislation really moving between now and the end of the year. I think in September, lawmakers probably come back, do some sort of continuing resolution, and then the next opportunity for legislation will be during that lame duck session after the election.
Were there any fireworks? I know, shame on me for not tuning in, but were there any fireworks in the SEC hearings?
Oh, well, the FDIC hearing.
I'm sorry,
for Martin
FDIC.
Bloomberg. Yeah, no, that's fine. Yeah, I mean, at this point, I think there was a lot of criticism amongst Democrats. Most didn't go as far as Republicans for calling for Bloomberg to resign immediately. However, it was clear that he's on very thin ice, and that any other future revelations could result in many Democrats sort of changing their tune to call for his ouster. But at this point, it looks like he will probably remain in charge, and that's sort of what we expected would happen. I think the other thing that was of note too is that Vice Chair Michael Barr sort of pushed back on some reports suggesting that some of the Basel III reforms were imminent. I think there's been a very big lobbying campaign on behalf of bigger banks who would be mostly impacted by that to push back against that. So my guess is the future of that proposal will hinge a lot on the election. If Biden remains in power, probably move forward with that. Obviously, if Trump comes in, he will look to reduce bank capital requirements.
All right. Well, in terms of the overall markets, obviously watching the S&P, this breakout gives us another 300 points in terms of a count on the upside. That's somewhere close to 5,600 on the S&P. So good news there for the market bulls. 10-year yields in this range, 480 to 435. Again, I think they're peaking. 2-year yields probably on their way to 425 in terms of that top. And then Bitcoin starting to emerge along with gold. And I think the gold consolidation is really, really telling, not in terms of what that means for monetary policy and the like, but huge momentum in gold. A couple months ago, got our oscillator up to 5 deviations, which is usually indicative of a trend change or escape velocity, if you will. We consolidated. We did everything that you'd ask gold to do in terms of being a consolidation in a bull market. Held the 50-day, and now looks like it wants to break higher. So we're looking for gold 2,800 in our count for the future. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and LinkedIn. And again, if you want deeper insight, join us at RenMac Access. That's RenMacAccess.com. And if you want to see our mugs, I don't know why in the hell you'd want to do that, but if you want to see us do this podcast in video form, you can subscribe to our YouTube channel, RenMac. Just search RenMac and that will come up. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.